Okay, so we should be getting our next panel here going very quickly. For some reason, we seem to, I don't know if I know they were here. Just give us a few seconds. Paul and the other panelists, I'm going to need to have you go out. So I do apologize. Oh, there's Ravi. Ravi's coming in. Marty, there we go. I apologize. See, like I said, I did warn everybody in advance that it was going to be bumpy. This is a new event management system we're using.
That's okay though. If you're not trying, Oscar, I mean, come on, what are you going to try and do? You got to get better every day.
And I hope you like this one. I really like the software. It's got a lot of great features for everyone. So
you look a little thinner, so that's great. You've been working out some. So
well, I believe. Okay, so here we go. Lewis is there. So that's the important thing. So you, Lewis, you just need to turn your camera on, bud, and there we go. So
all right, I had it on before. My apologies, everyone.
No, it's okay. There you go. You are on.
Great. Well, thank you, Oscar, and the KoreConnects team, as always. We really appreciate you having us as a part of driving digital securities forward. And today's KoreSummit topic on digital securities, we have the pleasure here of being joined with Louis Cohen, co-founder of DLX Law, and Ravi. I don't want to mess your last name up, Ravi, so I'll let you say that. Who's a partner at Acamona, excuse me. And the topic and my name is Elliot Chun here. We've actually just rebranded, so our name is now AP Crypto, and we focus on M&A advisory and strategic financing for companies in the digital asset space. And so we're going to have a robust conversation here on the topic of types of digital assets, which there's a lot of them, but we'll talk stablecoins, NFTs, security tokens, and even some fractionalization. With that, I'll pass it to Louis for a quick intro on himself. Louis.
Hey, Elliot, thank you so much. And it's such a pleasure to be here with the whole KoreConnects team and Oscar as well. So it's a pleasure. My name is Louis Cohen again, and I'm a partner and co-founder at DLX Law, which is a boutique law firm focusing on digital securities and other digital asset transactions. Ravi?
Hi, my name is Ravi Srivastava. Nice to meet you all. And I am a partner at Acamona. It's the first fully 100% smart contract-based funding protocol. Thank you.
Excellent. And then, so I've spoken, Louis, you and well, I guess we have been into this world for a while now. And, from early days, 2017, 2018, now we're in November of 2021. Man, a lot's changed, huh?
And it feels a lot has changed. And, I give folks like, KoreConnects a lot of credit for, I recall back in that period talking to Oscar and saying compliance was going to really be a leading factor in business success. And a lot of people didn't want to hear it back then, Elliot, as you know. And the fact is, the world comes around, and we're starting to see more and more, market participants, issuers, broker dealers such as yourselves, realizing that, a hard focus on compliance is critically important. Now, the catch here is figure out exactly how you comply and with what you comply. But I think a compliance first technique is now something, an approach that is absolutely, critical. And one of the biggest changes I see, although I will say as a lawyer in the space, we still get our fair share of calls from prospective clients saying, well, how do we get around this, that, or the other thing? And that's obviously something we do not put up with at all. Ravi, you just we'll maybe pay a little bit of rugby here, tossing the ball around, but I'll toss over to you because you're doing perhaps some of the most exciting work right now in the digital security space with your platform, and we're prepping a little bit about it. But I think folks would want to know your approach to compliance and how you're trying to bridge the gap there.
Right. Thank you. And this is very. I think that digital securities and digital assets, they have passed through a number of stages in this entire crypto technology. We believe that cryptocurrencies that are the first wave. So at some point of time, the first wave is going to give space to the second wave, and second wave is going to be the digital securities and digital assets, which are regulated and which are used by the by investment banks and by exchanges. And that's the reason is, if you look at the efficiency, the efficiency of digital securities is at least, we did a calculation, it's 9x to 10x more efficient than dematerialized or uncertificated securities. Because
9 to 10 times more efficient. That's I'm glad you put some quantification around that, because I haven't been able to do that. How? And when you think about it, is that a factor of time? Is it a factor of different counterparties that have to get that are part of the process along the way? What goes into that number?
Good question. So here is what you can do. You can take the operating cost of the depository, all the depositories. You can take the operating cost of exchanges. You can take all the operating cost of clearing agencies, add them together. These are publicly available numbers, and then find out total number of transactions executed on the exchanges, publicly available number. By doing this simple mathematics, you will be able to find out what was the cost of each transaction that was executed on NASDAQ or New York Exchange, two largest exchanges. And once you have got that, you come to blockchain, find out the total number of transactions which were executed, what was the cost of execution of each transaction. Again, publicly available numbers. You compare those numbers, you will be surprised. And by the way, these numbers do not include the cost incurred by broker dealers, because those costs are not available.
Yeah.
So we left out a big number, and then we looked at just the cost of depositories, cost of clearing houses, cost of exchanges, and left out a broker dealer, and we found that, wow, this is. And when you look at,
and is that a combination of cost and time?
No, we did not include time.
Okay, just cost.
And we just included the cost because, and again, you have a great point, because with digital securities, settlement, there's no difference between settlement and the transaction. They are one and the same. And with the uncertificated or dematerialized securities, you have 2 days it takes still to settle. So efficiency, our belief is that it's always that something that more efficient technology comes in that will replace a less efficient technologies, and we have seen this in history. This is the same example that Steve Jobs used to give of a difference between a human walking on foot versus a human using a bicycle. So bicycle was 1,000 times or something, 100 times more efficient, and I think that we are seeing the same change.
Elliot, I think you're going to be driving a Lambo. You're gonna lap the guy on the bicycle.
No, not even Lambos. I'm talking flying taxis. I mean, we're almost there yet. But we're also joined by Dr. Kiran Garamella. How you doing, Doc?
Hey, pretty excited to be here. Awesome.
We just had Ravi post a headline number of 9 to 10%. Digital securities being 9 to 10% more. 9 times.
Yes, sorry.
9x. You're right. 9x to 10x more cost efficient than a what were you calling a dematerial security? What was the phrase?
Generally, these uncertificated securities, which are basically ledger entries, because if we go back to the times before 1970s, I think their paper securities were traded, and paper securities were settled. And at that time, the big issue was that securities will sit at brokers' places for months before they were really mailed out. And that's the reason the new system was implemented, where all the securities are held at the depositories as ledger entry. And then they go through all the clearing houses and exchanges, and then eventually settle them. And that's an expensive billions of dollars of infrastructure has been created to support that, thousands of people working to support. So so materialized security is a security which was a paper security, but it has been converted into a ledger entry.
Got it. When we're using securities, like everyone knows what that means, and having been in the industry and seeing the transition of what is a security and what is not a security, I'll go to Louis, the lawyer here. Definitionally, where are we when we say kind of what is a security as it relates to the digital component that we're talking about now?
Sure, that's a great question, and one thing about the whole what is a security question is that digital securities and other digital assets have really caused a lot of confusion, blurred the line. But it's important to bear in mind that this question about what exactly is or is not a security has befuddled lawyers, since the dawn of the securities law. So this is not a new problem. The key thing is here in the U.S., we have a principles-based test for what is a security. So some sort of assets, the most obvious of which are stock in a company, are unequivocally securities at all times, in all ways, et cetera. But other types of assets may or may not be securities. So for example, a note is listed by the SEC, listed in the Securities Exchange Act of 1934 and the Securities Act of 1933 as a security when the context requires. But if I go to a bar with you, Elliot, and you spot me $50 and I write you a little note afterwards and say, I promise to pay Elliot Chun, $50, in 3 weeks when I have the money for it, plus another 3% interest, that note, it is a note, it's not a security. So determining when those instruments are or not securities has befuddled people long before digital assets. Digital assets have made it much worse because they're even more blurry in terms of what they actually are or are not. And, the current SEC would like to adopt the sort of similar test we have in the Supreme Court for obscenity. I know it when I see it. I can't define it, but I know it when I see it. And that's the walk like a duck, talk like a duck test. The problem for that is that there's so much activity going on right now. Market participants sort of struggle to know when it's a duck and when it's a platypus because they have some similarities, right? They both got the beaks and all, but they have other things that are different. So it's very challenging. As most folks at this point will know, in most cases, the Howey test applies. Howey refers to a company, J. Howey, that tried a scheme to raise money where they ostensibly sold orange groves and raised money through that. But in hindsight, it was viewed that really nobody wanted the oranges. What they really wanted was to make money through management of the Howey company. And that's really become a test in most cases. So that's kind of just a quick high-level overview, but it continues to vex us to this day. I think we'll talk a bit about NFTs. I'll circle back a little later to show why NFTs can be complicated as well.
Yeah, and it just lays a foundation, and we talked about this at the outset, is one around compliance. And 4 or 5 years ago, it was, do not put this stuff in. It is counterculture to why this technology exists. We don't want to go that route. And as we evolved through various stages from ICOs, utility tokens, even yield generating DeFi today, credit, crypto lending is the returns or the yield that you're receiving considered a security? If so, then what's the difference between that and what a bank does? All these things are getting actually more and more complex And by the way, a year ago, we weren't having these conversations with DeFi or NFTs. I mean, they existed, but nowhere near the level that they are at now. So it's almost like the velocity of innovation is happening so fast that definitionally, the industry is even having a hard time struggling with identifying what is something and what is not something. But I think what we're coming to is that the compliance and the KYC component of it, the compliance, KYC and AML component of it, is starting to come out as, well, yeah, we need to have, if we have that base layer, then the activities that we were talking about, DeFi, NFTs, stablecoins, whatnot, we feel a little bit better about them being more regulated versus not being totally anonymous and not having that level of counterparty management up front. Dr. Karan, any insight on, as you've seen this kind of evolution around that kind of key point at the in the process?
No, absolutely. I mean, this whole notion that Ravi mentioned about dematerialization of dematerialized securities, that strikes home to me because, I invest in international markets. And when my broker called and said, Kiran, we're going to dematerialize all your securities, I went into, I said, oh my God, what's happening? What do you mean dematerializing my securities? You can't do that. And so he kind of explained what that actually meant. And this was several years ago. And what's happening now is that when you supposedly dematerialize certain securities, all you're basically doing is making it a bunch of electrons and electronic records somewhere, right? But now with blockchain, it almost feels like, if I may give extended analogy, we're rematerializing all that in a much more solidified form on a blockchain, right? It's even more immutable than even the old material paper-based securities that we had before, right? But with that flexibility, I think we're seeing the innovation being pushed in so many different ways. It's unbelievable. I think there's a convergence now of not just blockchain, but also artificial intelligence. What happens to all of the data that goes with it, right? So people have this big innovation. And I think this is the most fantastic space to be, because if I think about, how we're headed in the next 10 years or so, the sea of finance is going to change dramatically. I think we'll have many more stable coins, many more branded coins. We'll have non-fungible tokens running around. We'll have securities of various types. Lewis, you mentioned promissory notes and debt instruments and so on. I mean, we're going to see a lot of that. And we see day in and day out when we talk to some of the issuers, what are the different types of innovations that are actually possible in pure share-based securities themselves. And it's unbelievable. So I'm really looking forward to this one. And, I don't think any person is going to have all the answers. It is really going to be a very, very collaborative effort.
Right. And just one thing, I feel that we have an obligation also. Those who are in the blockchain industry, those who are joining in the blockchain industry, we have to make sure that we leverage the strengths of the blockchain to create transparency. Because what has been lacking on the Wall Street is transparency. And if there was a full disclosure, if there was full transparency, Madoff would not have been able to do fraud with billions of dollars. And the only reason he could do because there was no transparency about the transactions that he was executing. So I think that because this blockchain could be used, digital securities could be used in a way that may not create the right level of transparency, or it could be used in a way that creates full transparency. And I think that there is an obligation to make sure that we create more transparency and significantly more transparency than what was available until now.
100% agree with that, Ravi. And I think, transparency always clashes with the privacy. People say, hey, how transparent do you really want to be, right? And I think our next resurgence is really going to be in the space of zero knowledge proofs and oracles, promising credentialing certificates and so on. I mean, I think we're going to see a lot happening in that space.
There's also just to pick up, Ravi, you gave a great overview, especially as a non-lawyer, for kind of the paperwork crisis, which led to the transition from paper-based securities to the DTC being formed and having a central clearing agency. There was another big step forward then after that, which was the revisions to our state laws, Article 8 in particular, to allow for another type of legal interest known as a securities entitlement. And one of the challenges we've seen as lawyers is we have this very tangled web of current laws that kind of are designed for an intermediated system and not so much for a disintermediated system. So there's definitely some spade work to be done along the way. Elliot, also an important thing for broker dealers is the customer protection rule, and the SEC is very, very concerned about that. If a broker dealer is going to hold digital assets on behalf of a customer, perhaps as a prime broker to provide leverage to the customer, then it has to be held in a good control location. And that in turn means a bank. So there's a lot of different, pieces that are going to have to be stitched together here. We have to remember that.
So let's talk a little bit about actual use cases, because we've talked about digital securities. We talked about some of the important compliance and regulatory around it, but this is the exciting part. What are people looking to use it for? And Ravi, you had mentioned cryptocurrency being the very first use case of that. So Bitcoin being the first use case of blockchain, the technology, and then we have all these different protocols where other groups are building on. We're going to take all those to the side, and we'll just call them, that's kind of Gen 1. And now as we transition to a Gen 2, we have things like stable coins, security tokens, NFTs. So let's get into some of those use cases, those cool use cases that we're seeing, and talk about how they are maybe bringing the 9 to 10x efficiencies into how they're being applied to what exists currently.
Right, and good question. And I think that the next evolution of blockchain is going to be in digital assets, for example, like securities, stocks, bonds. The particularly bond market is not very transparent. So if bond market could become transparent, then that would be a huge evolution and huge value of blockchain. And we have been hearing that in fact federal feds are looking at creating a digital dollar. And that digital dollar could really create a huge transformation, because the benefit is you don't need to really go to a bank to transfer money. You could transfer money directly without going through the Visa network or make that transfer. And so we are seeing the evolution of stable coins. We are seeing the stocks and bonds. The benefit, again, there is a huge benefit because, as Kiran said, we are seeing rematerialization. And people are getting the custody when they had paper securities, which was in their custody. They lost that custody and the transparency that came with those paper securities when these were dematerialized and turned into an electronic ledger entry. Now they are rematerializing, and we are seeing that people are getting the custody back. So people don't have to really go to someone in order to sell their securities. They can say, I have the custody. Of course, there are challenges come in, because those who are holding securities, eventually they will need to have some kind of insurance on their wallet, and somebody will have to provide that insurance so that if they are lost. But we are seeing really the significant change, and that's going to be the second evolution, second wave.
Yeah, maybe I don't know if I'll Elliot, if you want me to talk about something else that I find super exciting with the idea of digital securities and digital assets, is the line between where you have a business and where you have a group of people that are engaged in something that's a little differentiated from that. And so some of you may be aware in the area of NFTs there are a number of series of NFTs that are each differentiated from each other, but they're all kind of have some commonality to them. One of the most popular is the Bored Ape Yacht Club. And what we've seen more recently now is people acquiring some of these NFTs and then forming businesses around the open source intellectual property here. So previously, if someone had intellectual property, whether it's the Coca-Cola brand or Walt Disney's Mickey Mouse or anything like that, they guarded that very carefully and they didn't allow others to exploit that IP. We're now seeing blockchain technology being used to start new businesses, which may well do, for example, a Reg CF offering of digital securities, but around this open source IP. And so that's really interesting as we see these two worlds of digital securities and non-securities kind of blending again. So I think what blockchain technology allows is this kind of blurring of the line of, one type of thing and another, and that's very exciting.
So when in Ravi's use case, we're talking about making capital markets more efficient, right? Equities, stocks, bonds, those things that currently exist in our world, putting them into a digital wrapper and then enjoying the efficiencies that come from that. Louis, when you're talking about here with kind of the Bored Ape Club, that use case to me is very much around a different way to engage with your consumers who may also be your investors.
Yep.
But more importantly, kind of fan and consumer engagement, being able to create connections to those and then be able to tie you to a certain value that you can deliver to them, or aligning interests there.
Yeah. So if I may share a couple of insights into this one, or some thoughts around this. So anytime, we always think about the blockchain and digital securities as being much more fluid and much more efficient, right? And that's a great play. I mean, that is a big disruptor by itself in the financial markets. But one of the things that we also have to recognize is that when things get more efficient and fast, people think of very new use cases as well, right? So when you're riding on a bike and then you have a powerful Ferrari car, you are going from point A to point B faster. Yes, that is true. But it also adds so many other use cases to that. You don't use now a Ferrari to go pick up milk at the grocery store, right? I mean, you have the NASCARs, you participate, there's a high-speed days, and there's a whole excitement around this whole thing. I think in the same vein, I mean, even in blockchain and digital securities and NFT space, Louis mentioned a great example of, NFTs. I mean, if you think about it, securities are basically representing a pool of assets. In this NFT's case, it just happens to be one asset that is irreplaceable and one of a kind, right? The other part is also stable coins. If you look at stable coins as a mechanism for making your financial transactions much more efficient, but now think about people issuing large companies or ecosystems stable coins that represent their brand. Right? You have so many of these ecosystems out there. You have clubs, you have communities, you have ethnicities, and so on. And now they can produce their own stable coin, which is now branded. There's a pride of ownership of a stable coin and being able to use that. And there's a lot of use cases that can come out of that one too. I don't know if you guys have any thoughts around that.
I do. I'll just quickly just jump in on the regulatory side. I couldn't agree more. That being said, as you probably are aware, the President's Working Group came out with a report about 2 weeks ago or so, which definitely was rowing in the other direction. So we're going to have to see how that goes. So the President's Working Group was concerned that these type of stablecoins could become systemically significant, and so took the position that only an insured depository institution, or IDI, basically a bank, could issue stablecoins. Now, that does not mean that we may not see partnerships along the lines, Kiran, of what you're suggesting between sort of brands and stablecoins, as we would put a kind of a white label service. So we see a number of banks, Signature Bank, Cross River Bank, a number of others that are providing services to the blockchain space. We may see insured depository institutions providing these, but it is going to become interesting to see how the requirement that a bank is involved plays out in this space, for sure.
Oh, absolutely. If somebody's going to put out a stable coin, people had better be sure it is in fact stable. I mean, we have seen these fiascos with, some with the Tether and some with some of the other stable coins, right? We do want to absolutely avoid something like that. No doubt about it.
That's right. Although a great irony is that an insured depository institution engages in fractional reserve banking, and so by pushing stablecoins into a fractional reserve status, they actually are, kind of counterintuitively. But look, I think we can all agree there's a lot yet to be determined. But I think, Karan, your point, really just picking up on that, is there's going to be a need for different stablecoins in different settings, and we'll see, I think, symbiosis between brands and banks or issuers, creating all kinds of new and interesting products.
Is it too late for us to change the name of stablecoins? Because it just feels like it's just a misnomer and it gets people confused. And it was it's like smart contracts. It was really early that we coined it, yet stable coin and it helps. I don't know what to call it, but it's the vernacular has been tough.
E-money, so that's like a term. They have that term. It's e-money, and that's an interesting, different term. To your point, it doesn't use tokens, but I think it's a great point. I'll just throw in my support on better name.
Well, because the use case of them is so important, but it's important to us because we're in the infrastructure in terms of building this out. It's less important when you talk about the everyday consumer that doesn't necessarily need to understand exactly what's happening under the covers, but they should be confident that whatever is happening under the covers is done in a manner in which there is a framework, there is structure, and most importantly, there's accountability if it doesn't do what it says it's going to do, and it breaks all of a sudden, right? And I think that is one of the biggest challenges. Well, that's probably one of the biggest psychological differences in the world of blockchain and crypto from 5 years ago till now, which is, I think, now we're starting to get regulators up to speed, and we're starting to see approvals happen for a broader set of use cases than we did before. And I think now we're saying, okay, this is the path forward. But just changing briefly, the Staples Center is now renamed Crypto.com. I mean, that is that's not a minor thing, particularly anyone in LA and Hollywood and where the Lakers and the Clippers play. So but if we start going down into talking about stable coins and securities, the common person they're going to get lost. And what I hope doesn't happen is the strength of the use case that is seeking to be adopted gets caught up in the quagmire of stuff.
Right. So here is always, and I agree with you that stablecoin is a misnomer, and the reason is there is no transparency regarding the assets held by the issuer of a stablecoin to support the stablecoin. So we have no idea if the stablecoin is backed by $10, if 10 million stablecoins are backed by $10 million, or whether 10 million stablecoins are backed by $10. We don't know that, and that's where there is clearly a need for creating more transparency, because sometimes the issuers of stablecoins they appear to be behaving like a bank, and some of them, in fact, who consider their obligation seriously. They have voluntarily adopted all the regulations which apply to banks. And there are others who are not really clearly disclosing and how much assets they are holding and where they are holding those assets. So that there is a challenge with stablecoin, and I agree with you. I don't think that stablecoin is the right name.
Yeah. I was just going to add one more thing, around stablecoins that's a potential challenge. The SEC has made some noises about whether some or many or maybe even all might be considered securities. That then raises, other questions in terms of how that stablecoin is traded. So it may not as easily be traded on digital asset exchanges that are intended for non-securities and could have a variety of other sort of implications. So there's some really interesting aspects, knock-on aspects there.
Ravi, you had a really interesting use case you were talking about earlier in terms of a car and a digital form of a car being bought and sold, and how that could happen. And probably 5 years, less than that, from an everyday user perspective. Can you talk a little bit about that use case?
Right. So the concept which we were talking about was that when the trade takes place and the property you are holding. So if you have invested in a security, and then it's your property. But here's right now, because the securities are not held by you, held by another by a broker dealer in form of a ledger entry, it is broadly controlled by another person. Once it is in the form of a token in your custody, then like a car, you can sell it to another party. Now, the second part is that all the cars need to get registered at some place. So the ownership has to be registered. So once you have traded the securities, once you have sold the securities to other party, that other party needs to go to the transfer agent to register their ownership. And they can say that because the security is in my wallet, therefore now I'm the owner, and register my name. And the transfer agent can say that, okay, let me verify from the previous owner, or transfer agent, there are some gray areas here, or the transfer agent can say, because it is in your custody, you are the owner, and therefore I'm going to register you without even following up with the other person, with the original owner, and I will do a KYC AML, and after that I'll do a registration. So that's a DMV model, that you get the ownership of the car and get registered. Lewis asked a question that was a very good question. What if the person who has bought the security does not pass the KYC AML? And that's a good question, because if they do not pass the KYC AML, a transfer agent cannot register them. So they have to say, just like the DMV model, the car has got certain defect, it cannot be registered. So the person who has bought needs to go back to the person from whom they had purchased the security, and they need to resolve the issue with that person. So that now there are some number of, I'm sure that Lewis knows a lot of legal issues around that. So maybe Lewis, you can take over from here and help us. What would be the legal issues around?
Well, I think it's not. I think we'll put all of our friends and colleagues listening in to sleep if I start waxing on about Article 8 of the Uniform Commercial Code. We'll surely lose folks. But I think, to suffice to say, Ravi, there are technicalities that can be quite important to this, but the principles you've laid out, are really good high level principles, and I think that's what's great. And I think Kiran and Elliot, that's what gets people sort of excited about the space. But maybe I'll turn the question back to you, Elliot, which is, isn't probably in my mind, the single most important driver here. The technology can give you that 9 or 10 times efficiency gain, but at the end of the day, it's garbage in, garbage out. So we need good issuers to kind of come on the platforms and engage and really, start to say, hey, I'm selecting things in this way, not because I can't do it otherwise, but because this is the best possible way to issue securities. But I'd love to hear your take on some of the folks that you talk to about that, Elliot, because that's, to me, the quality issuer is the sine qua non of success here.
Yeah, and it's been one of the biggest challenges, particularly for digital securities today, because we don't have enough good examples to point to. to say, hey, did you see what they did? This is a very well-run process from a great company that had options to go with. They selected this option, and now they are reaping the benefits of their decision. The initial use cases that we have are primarily in the real estate side, right? And it's mostly because we go back to education, and I know it's a part of the theme. It's not just education of the issuer, but it's education of the investor. And that has also been a significant friction point, meaning it's almost easier for me today to not take the risk of owning and involving in a digital security when I've got a piece of paper and I'm okay with having my paper version of this of the same security, right? Essentially. So people, why would I take the risk of trying to do something that's quote unquote unproven, or I'm not seeing good examples of, when I can just have my paper version here? And so I can't tell you the number of conversations, particularly with lawyers, where they would sit there and say, oh, well, okay, now you have a digital security, trades in the secondary market. Yes, you have access to your capital, but what if there's no market there? And I'd rather be locked up than have access to sell my position, right? So these are real world questions that we are fielding from investors on a near daily basis. And you know, it's fine, because that's just the education curve that we're going to need to as an industry to be able to implement. But look, ideally what happens is, you know, Tesla issues some round in a digital security structure, and then it's game over. Like, it's just going to open the floodgates, and people are going to say, well, what? I can own Tesla in this digital form, and it's a security? Like, I'm in. And then people are going to do their comparison to, well, wait a minute, this version of this security can do all of this stuff, and this old version of my security can only do this stuff. Why would we ever do the two? But the problem is we just haven't hit traction yet and had enough of those good examples to point to, so people can nod their head and say, I get it. Yeah, but it's events like these that really help push that.
Yeah, Elliot, I think it's going to be a spectrum of people. You know, there are some early adopters and innovators who say, you know, hey, I'm going to try that because I can see very specific use cases. And it's not because some people are more visionary than others, well, which they are, but the more important question is that some have some preferences and risk profiles that are different from others, right? Some people are risk takers and they want to push this envelope a little bit, right? I mean, a classic example to your point, I mean, you raised a fantastic idea about stable coins. I mean, should we even call them stable coins? I mean, if they're not going to be stable, then why call them stable coins? But we kind of run with this idea, and I've been thinking about this one, we've been talking about this stuff internally too, is that you remember SDRs, the special drawing rights that the International Monetary Fund put out, right? And why did they put this out? Because you had different currencies, and because of the exchange rates and the inefficiencies in moving money across countries and for governmental purposes. So they use SDRs as a claim against the basket of currencies, right? Now just think about having a claim, a stable coin issued like a private drawing right, if you will, like a PDR. But it's a claim on not just that one company, but its partners, and it reflects on the credibility of that basket of partners, and it's a claim on their credibility, right? I mean, it can be used like that. I think we're going to see quite a bit of innovation in this space.
So I mean, a year ago, DeFi was just getting started, and NFTs were just starting to, like, NBA Top Shots was just starting to get in the market. You fast forward now, and both, I mean, I don't know what total value locked, which is another horrible term, but TVL in DeFi is like in the billions, right? And it's a bad number. I think it's going to bust at some point. But the point is, people have appetite for the innovation. It is happening today. NFTs, if you look at weekly volumes, some weeks it's 100 million. Again, the data is not the greatest, but let's just go with what's available right now. You're seeing 100 million in NFTs trade on particular marketplaces and exchanges. These are that's a week. That's per week. These are huge numbers. What does that indicate? That indicates that there is a level of and the other part is gaming. You're seeing these NFTs from play to earn. I mean, they are just exploding now. So the appetite to participate in innovative products is there. Why is it not happening in the quote unquote security side? And it just happens to be because, and we can point fingers or whatnot, but the regulation is not there. I mean,
well,
we just got the ETF signed off, right? Like how long did it actually take to get that? And they're still pushing back. So there's just a significant amount of pushback and friction in regulatory markets. But we're seeing what happens. And again, I just want to clarify. Yes, it's great that DeFi has got a lot of activity going and NFTs, but in the way that its current state is, it's going to combust at some point, and it's because the regulation isn't there. So I know we're walking this line.
Well, I think I think the crucial fact in all of this is I think Lewis hit it right on the head. It has to be a compliance-driven or a compliance-first process, right? And one of the biggest areas, I think we all as an ecosystem are looking at is how to make these things much more compliant. And part of the answer then goes back to the question of smart contracts. And, we think of smart contracts as smart and they're contracts, but technically they're not. So we have to make them smarter. We have to make them even stronger in terms of being contractually obligated for compliance, right? I mean, that base really should not go out. Once we lose our eye on people don't like compliance because they think it's a regulatory burden and unnecessary bureaucracy. But at the end of the day, it is for the safety and security of all the parties involved. And if you make it much more fluid and take out all the inefficiencies in compliance, I think that has to be the firm base for going forward.
I know we need to wrap up shortly, but Oscar, we had a question from the audience.
We do. Yeah, two great questions. I like them. You want to take it on?
I'll take on the first one, at least, on decentralizing deeds from real estate, deeds that are used in real estate to own properties. So it's a great question. A lot of people wondered about that. It's very interesting. I actually, coincidentally, had worked on one of the earliest projects to achieve this, the second largest registrar of deeds in the country. As many may know, real estate is transferred at county level registrars. And Cook County in Chicago did a pilot program where they sought to use the Bitcoin blockchain to transfer real estate deeds. And so I was just looking for it. I may be able to just quickly drop the final report into the chat to share with everybody. Their conclusions were there were some really interesting things about this approach, but with deeds to particularly somebody's house, transferring that on an open public blockchain would be difficult for many of the same reasons that, Ravi, you pointed out with securities. Nobody wants to wake up one day and find that somebody hacked their wallet and now they don't own their house. That doesn't really work very well. So I think there are going to be some really interesting blockchain use cases around real estate, but probably like decentralizing it is going to be difficult because, again, people have rather strong feelings about their home and not finding out that their home has just become a bearer asset. But I'll try and drop the report into the chat right now, and I'll let somebody else answer the other question.
Thank you, Lewis. Actually, you know what? That is a real. One of the things I want to tell everyone, and Lewis has been on the leading edge of this in advocating from a different perspective from a legal, and that is that nothing is saying that one part can be decentralized and the other part can be centralized. I think we need to start thinking about, we need to mix the models because there are so many different regulated components to this. Well, they're not going to go away. Real estate is a regulated activity. I think we all agree on that. Perfect. Fantastic. There's banks involved. There's all that. So I think anybody getting involved with this, you just need to understand that puzzle just got a little bit different than it was a few years ago. It's not just simply saying, hey, I'm going to do decentralized real estate. I'm going to, fractionalize. Make no mistake, fractionalization has always been there.
Anybody who's, Elliot reminded me of that. David Wheel tells me it's always been there. Blockchain just makes it more efficient. It makes it doable. It makes it practical. And you need to understand. So when you understand how difficult it is to do it, boom. There is one question in here. Obviously, Elliot, this is for you, and Ravi and Karen, of course. Can anyone share their experience on launching an STO, and what are the key steps to preparing one? So it starts obviously with people like Elliot and the lawyers, but Elliot, please.
Yeah, I think the first thing to consider is, what are your objectives, right? And that's always the key. You don't want to go into something just because it is new. You need to establish what are your objectives, and then you come and say, what are the structures that can allow us to gives us the best chance for us to succeed in meeting our objectives. So that's one, because we saw this in the ICO move, that when people tried to raise capital in a structure that worked for them, but didn't work for their investors or the people that were along with them on the journey, it's going to break in the long term. So it's very important to make sure that there is an alignment of interest and you're doing it, you're thinking that through properly. So that's the first step with STOs. And then the second becomes the who. Who am I reaching out to? Who do I expect to engage with me and become an investor into whatever I'm issuing? That's a very important step too, because if you are doing something that is consumer based, yes, that may have a lot of alignment to what your consumers or your customers are thinking, and then they can come and invest into what you were, whatever you're participating in. But if investors may be kind of your more traditional groups, you may turn them off because that may not be what they are seeking for. It may not align to their investment objectives, or they may have documentation that doesn't even allow them to invest into a digital security. So the 6 successful security token offerings have been ones that do a lot of the thinking up front, think about alignment of interests, and then construct the story and the messaging so that you are making it as simple as possible. Very, very bad to say, I am doing this digital security because it's the newest thing and it allows for things like liquidity. No, that doesn't work. Focus on what is the story, what is your value proposition, and then you hit them with, and you can own this in something that is more capital efficient, something that is helping the way that that shows to you that I'm thinking about you as a long-term person that's coming with me on this journey. And so that's a lot of the things that we think about at the early stages when people are talking about digital securities and STOs.
It's a great summary to that. And one thing that Elliot did not tell everyone, we do not use the word liquidity in private markets, right, Elliot? We use the word monetization because we need to be honest with the market. Elliot did a session for us, and he was the first to bring it up. I think in the middle of the year, we were talking about, because secondary market opened up, and you can hear about it. And this whole thing is liquidity. Liquidity does not exist in the private markets the way it does in public. And it was great. You're going to learn about that later. So, okay, so here's what's going to happen. We're getting better at this. So the session is going to end. What that means that everybody's going to be moved over to the lounge. Speakers on the top right left-hand corner, there's going to be an arrow that you click on. That arrow, it's going to push you back there. There's already tables ready for you. There's some people there like Chuck, Makar, and Matt that have additional questions. I'm sure they're going to be reaching out to you. And of course, others. Thank you so much, everyone. We'll have the Core Partner Lounge break, and then we'll be back in about 10 minutes. Thank you.
Thank you, Oscar. Thanks, guys.
Thank you.
Thank you, Oscar.
Thanks. Bye.